You do not need 20% down to buy a home in the Bay Area. The number one thing keeping people from buying a home in the Bay Area right now isn't the market. It isn't the interest rates. It's a myth. And I've watched it keep really good, financially responsible people renting for years longer than they needed to because nobody sat down and corrected it, helped them put a plan in place and go over their options. The myth is that you need 20% down to buy a home. You don't. And I want to walk you through exactly why, what your real options are, and how to think about this the right way. Because once this clicks, the whole thing looks differently. I'm Stephen Lamb. I'm a Bay Area realtor with Keller Williams. I do about $15 million in volume a year. And before real estate, I spent 12 years as a school counselor. So when I explain something, I'm not trying to impress you with jargon. I'm trying to make sure you actually understand it. Let's get into it. So where does the 20% myth come from? So first, let me give the myth a little credit because it's not completely made up. There is a reason 20% became the number people talk about, and it comes down to something called PMI, Private Mortgage Insurance. Here is essentially how it works. When you put less than 20% down on a home, the lender sees that as a higher risk loan. So they require you to carry PMI, which is insurance that protects them if you default. And somewhere along the way, people start treating PMI like it was a catastrophic extra cost that made buying with less than 20% down a terrible idea. But here's the thing. I've seen PMI as low as $89 a month. I've seen it as $120. I've seen it $200. For a lot of buyers, that's less than what they're spending on a car payment or a gym membership. It's not nothing, but it's nowhere near the deal breaker people think it is. There are several loan programs that let you buy a home with significantly less than 20% down. Conventional loans can go as low as 3% in some areas. FHA loans go down to 3.5%. There are also programs specifically for first-time buyers that have their own down payment requirements and sometimes come with assistance. The exact options available to you depends on your income, your credit, and the price point you're buying at, which is why the first step is always a real conversation with a lender. Not just a calculator on a website, not just a Redfin calculator or Zillow ones, or not just AI, right? Now, I want to be clear about something. I'm not saying someone should put the minimum down. That's not the point. The point is that you have options, and a lot of people don't even know what these options are because they've been operating off a number they heard somewhere and they never questioned it. I want you to at least know what actual math looks like for your situation before you keep waiting. The PMI thing is actually solvable. This is the part most people don't know, and honestly, it challenges the whole conversation. PMI is not permanent unless it's an FHA loan. You don't just pay it forever and accept it as a cost of putting less down. There's a path of getting it removed, and it comes down to equity. Here's how it works. As you pay down your mortgage and your home appreciates in value, equity grows. Your equity grows. Once you build enough equity, essentially getting to that 20% threshold, you can request a reappraisal of the home. If the appraisal confirms you're at or above the equity level, the PMI can drop off. So think about it this way. In a market like the Bay Area where home values have historically appreciated over time, you might hit that equity threshold faster than you expect. You buy with 5% down, make your payments, and the home goes up in value. You get it reappraised and the PMI is gone. You don't wait the extra years to save the full 20%. You got into the market and you started building equity and you removed the PMI when the numbers made sense. I've walked clients through this exact process. It works. Now, another way to do it even quicker is you purchase something at 5% and you use the other 15% to add value to your home, right? Instead of putting the full 20% down, let's say you put 5% and then you use some of that money you saved up to force equity, update the home, add square footage, do a garage conversion. So I have helped clients run the before and after numbers so that their equity can drop off after the value's been added. So within 2-3 years time, their PMI dropped off quicker, which saved them about $300 a month, right? But the way I was speaking about previously, that is just saying the value of your home is improving or increasing over time so that PMI can drop off eventually. And real quick, if this is the kind of content that's helpful to you, go ahead and subscribe. I put out videos every couple of weeks that break down the real stuff about buying, selling, and investing in the Bay Area. No fluff, just what you actually need to know and what I've learned over selling over 100 homes. And if this video has been useful so far, hit the like button too. It genuinely helps more people find this. Okay, back to it. So, if 20% down isn't actually required, why do so many people treat it like it is? I think a lot of it comes down to fear, and I get it. Buying a home in the Bay Area is not a small decision. It's a big purchase, right? The average purchase price is like $800K plus. We're talking about $800K, $900K, $1 million or more in a lot of cases. The stakes feel enormous, and when the stakes feel enormous, people default to the most conservative thing they've heard. But here's the thing, fear based on the myth isn't caution. It's just a delay. And every year you wait, you're paying rent, which is building someone else's equity, not yours. You're also potentially watching prices move in a direction that makes it harder to get in. Now, I'm not saying buy a home you can't afford. I've said this before and I'll keep saying it. I do not believe in going mortgage broke. If the numbers don't work for you and your life and your goals, then I'll tell you straight. But if the numbers do work and the only thing stopping you is the 20% myth, that's worth a real conversation. Let me give you a hypothetical so this isn't just abstract. Say you're a family in the East Bay, you have solid income, good credit, and you saved around 60K. You've been waiting because you're looking at homes in the 900K range and you think you need about 180K to even get started. So you keep renting, you keep saving, and the goalpost keeps moving. But what if you actually sat down with a lender and ran the real numbers? With 5% down on a 900K home, you're pulling down about 45K. Your PMI might be somewhere around 100 to 150 a month depending on your loan. Your monthly payment is higher than it would be with 20% down. Yes, of course, but you're in the market. Now you are putting money towards an asset you own as opposed to paying someone rent that disappears month to month. You're building equity. That's a very different than I need 180K before I can do anything. I'm not saying that scenario works for everyone. It depends on your income, your other expenses, your goals, if you have kids or not. But I'm saying it's worth knowing what your actual picture looks like before you assume you're not ready. Here's what I suggest to do next. If you've been on the fence about buying because of the down payment question, the best thing you can do right now is get real numbers in front of you. Not a Zillow estimate, not a guess. The actual numbers for your situation. I put together a free guide called a Bay Area House Hacking Starter Kit. It walks you through how to make an 800K plus home in the Bay Area actually affordable, including how to think about the down payment, the PMI, and the strategies like house hacking that can offset your monthly costs significantly. The link is in the description. Grab it, go through it, and if you want to talk through your specific situation, reach out. That's what I'm here for. And if you want to keep going, the last video I put out covers 5 things I tell anyone buying their first home for the first time. It goes a little broader than this one, and it covers some stuff that'll make a lot more sense now that you understand the down payment piece. I'll link it right here. Go check it out.